Welcome everyone. We'll just start in a couple of minutes. We're just waiting for everyone to enter from the waiting room. So welcome to everyone to this CASA webinar as part of the CASA Breakthrough webinar series. As many of you will know who've joined the webinars before, the Commercial Agriculture for Smallholders and Agribusiness CASA programme aims to make the commercial and development case for investing in agribusiness that source produce from smallholders. And CASA's role is to bridge evidence gaps to ensure that investors and policymakers have access to the right information and people to make inclusive agribusiness models succeed. What we're doing in this webinar in particular, which is one of a series that highlights CASA's research and gathers the views of expert practitioners, is to debate the impact potential of investing in what's described in the CASA research as the underserved middle and elsewhere, versus investing in the larger and better established agribusinesses. So the questions we'll try to address during this session: how does investment create the biggest impact throughout the different sizes of agribusiness in the agricultural economy? And what types of agribusiness investment are possible for different types of investor? What's needed to serve the underserved middle? So we have panelists who are going to be able to provide a great deal of insight into this. I wanted to highlight that you can ask questions in the chat. Please do ask your questions. And if you want to flag them for a particular panelist, please point that out when you're making putting your question in the chat. If you could please try and keep them quite short, that will enable us to get to as many as we can. So I'd like first of all to call on Matt Hague, who's the principal researcher who's been working on this topic of the underserved middle. He is technical advisor at CASA and plays a leading role in the development and commissioning of the programme's research portfolio. As I say, he's the lead author of the Underserved Middle, Defining Excluded Enterprises in Agricultural Value Chains, and he has about 20 years of experience in working in monitoring and evaluation across the world, making clear that you can see the piece of work, the research paper, on the CASA website, as well as the recording of this video after the webinar. So Matt, over to you.
And is well now working. Everything's frozen.
Perhaps while we're getting this straight, I'll just make the point that we also have on our panel a range of really great speakers from a range of different organisations. So following Matt, we will hear from Louise Fox from the Brookings Institution. Then we'll hear from Brian Milder, who is in Aceli Africa, and then from Daniel Hulls from AgDevCo. So a series of speakers who will all add their insights to the conversation. Matt, over to you for the first presentation.
I'm trying to stop this video.
We can see you, Matt.
Excellent. Well, I can't see that I'm being seen. You would think that 9 months into using Zoom, we'd have had this sorted out. Anyway, hello everybody. By way of framing the discussion on where and in what areas of the value chain for agribusiness we should be looking to target investment, I wanted to introduce CASA's concept of the underserved middle, and also some information on what's available for financing of these needs. So CASA sees SMEs as crucial for the agri-food sector in Africa and Asia, especially in the midstream of value chains on processing, distribution, and retail of food, particularly for domestic consumption. 80% of food is handled by the private sector in Africa. 95% of smallholders sell to SMEs, and 80% of the midstream private sector is comprised of agri-SMEs. So supporting these SMEs to scale is important to consolidate value chains, and so companies can gain efficiencies that lead to lower cost, high quality foodstuffs delivered in principally urban markets. And whilst these SMEs face numerous challenges when trying to scale, one key factor is access to formal finance. But there are also other factors around access to policy and regulatory environments, market information, energy, and low-cost transport. So what do we mean by the underserved middle? The underserved middle is really bringing together two concepts that most people, I think, will be familiar with. One is the missing middle in terms of access to finance, and the other is the more recent hidden middle on access to other actors within the ecosystem. I mean, I think one of the emerging lessons is that it's not a question about there not being enough money, but it's that scaling firms can't access it at the cost and the form in which it's offered. So we have businesses when they're very small accessing self-financing, informal local financing, grants and micro-lending. And this can be at a maximum point of anywhere around $25,000 to $200,000. But for the purpose of CASA, we see this point at about $50,000. And then when companies get large enough, they're able to access more formal financing from impact investors, from people providing closer to commercial capital, finance and commercial banks, where the returns of larger companies and the volumes of financing that they need are sufficient to meet the costs and the returns of the investors. And again, where this point is depends on really who you are and where you're coming from. But with CASA, we've taken this point at about 2 million. So between this point of $50,000 on one end and $2 million on the other, you have scaling enterprises that have become too big for this highly concessional financing, but remain too small for impact investors and too expensive to reach for banks. And on the other part of the underserved middle is this notion of the hidden middle, which says that actually the missing middle isn't missing at all. It's actually thriving. It's just doing so without using formal finance. And it's also largely invisible to the policy debate. And this is important because these enterprises are the ones that are driving agricultural and food production, certainly in Africa. And they're not part of conversations with government bodies that are developing all those policies that affect them. The focus of this hidden middle is on the midstream of the value chain. So we're looking at traders, transporters, and processors. But it also goes, I think, further back upstream to agripreneurs or scaling smallholder farmers who've expanded production, have started to add into their business some aspects of SMEs. So providing inputs to other farmers or acting as a local aggregator. It can also include other areas where markets have been liberalized, such as in seed multiplication further upstream. So we have a situation where very large companies have good connections at regional and national level, and they can get policy decision-making on their side. They can use this to actually reinforce a dominant market position by guiding and supporting changes in local trade rules, in taxation, and they can also influence where really important investment decisions are made on things like infrastructure. And the smaller local companies are invisible to these forums, and as such, they're silent to it. So our definition of the underserved middle is this diverse range of SMEs across the value chain. They're unable to exploit the potential to scale that exists in the market due to their effective exclusion from normal market supporting policies, from financing, and from institutions. These enterprises are generally small. They occupy specific niches in the value chain. It's mostly, but not always, downstream of production. And it's mostly not innovative, and it's not expected to grow rapidly or to a great size. So these are not the gazelles that are waiting for a dollop of investment before they explode. But they do feel important, but not very glamorous roles in making value chains work and have substantial potential to create employment. So I think the message around the underserved middle is that reaching this segment of SMEs is not something that can be done just by investors or something that can be done just by government, but it requires the effective engagement of both parties. And at CASA, what we're doing is working with, in the first phase, which started about 18 months ago, 30 SMEs in three pilot countries, Malawi, Uganda, and Nepal, and six different value chains. And we're working with these companies on the one hand to understand and address a lot of these issues around access to systems and ecosystem policymakers and other sort of market intermediaries. And on the other side, making them more bankable by looking at revising their sort of business cases and developing pitches and other sort of mechanisms that they need to approach the market, and then plugging them into third-party financing. And we're looking to work with these companies who need financing within this range of sort of $50,000 to $2 million. And then sort of finally, in terms of the financing needs, we wanted to look at what information was out there on generating some big picture of understanding the financing needs for agricultural SMEs. And actually, it turns out there isn't a tremendous amount of information. There's a series of studies done by Dalberg and ISF over the last 10 years or so, which generate some very large, high-level figures. Sub-Saharan African SMEs facing a funding gap of $100 billion a year. Smallholder financing needs in their entirety, so farmers as well as SMEs needing 240 billion a year and only receiving 70 billion of that. So very, very large numbers of financing needs. And one of the challenges here is around having access to sufficient data on the scale and profitability of financing to the agricultural sector, partially over concerns over confidentiality and competition amongst a lot of these private financing companies and banks, and then issues of standardization of this data. And this is something that Aceli Africa and CSAF are trying to address by taking some very real world information and analyzing that. And hopefully we'll come on to that a little bit more with Brian in a minute. So that's all from me. Thank you.
Matt, thank you very much. A really great introduction to the research that you've been doing. And we'll come back to some of the points you raised when we come to the discussion, and please do put some questions in the chat also. Before we come to a couple of the practitioners, so Brian Milder and Daniel Hulls will be talking about some of these practical things that they encounter. Before we do that, we're going to go to a video from Louise Fox, who is a non-resident senior fellow in the Africa Growth Initiative, part of the Global Economy and Development Programme at the Brookings Institution. Her work at Brookings focuses on youth employment, inclusive growth and poverty reduction. And she used to have roles in the USAID as chief economist, visiting professor of development economic policy at the University of California, Berkeley, and various positions at the World Bank, including lead economist. She's going to throw down a challenge for us around whether at the larger end of agribusiness is where the focus should be, or whether we should be very much thinking about the SME level. So we'll play you the video, and then we'll come back to Brian Milder and Daniel Hulls after the video.
I'm Louise Fox, and I'm really pleased to be talking with you today. I apologize that I'm not there in real time, but I live on the west coast of the US, so it would have been very early for me. But I'm pleased to be here to discuss with you this important issue. So first slide, Alvaro, please. So what I want to discuss is whether Africa has a missing middle or a missing top. So you need a firm ecosystem that involves small, medium, and large enterprises. But the argument that I'd like to make is that perhaps it's the large enterprises that are missing. And those large enterprises, because they're missing, the sector is not as well organized, and the value chain is not as well organized. So next slide. I feel like there's kind of a myth about SMEs and development. SMEs are really important for development, and donors are really into SMEs. And, you know, the World Bank did a study some years ago where they defined SMEs as firms with under 250 employees. So a medium enterprise was a firm with under 250 employees. And they published an article that said, you know, around the world, most people work for firms with under 250 employees. Yeah, true. But 250 employees is a pretty big firm for Africa. Now, they subsequently revised that definition, especially at the IFC, and they define SMEs as under 100 employees. So the smallest 10 to 50 and 50 to 100 is a medium. It can be 10 to 40, 10 to 25, but you know, you get the idea. Now, when we look at the firm ecosystem that way, we see that yes, in Africa and also in other developing regions, SMEs do create a lot of jobs, but they also destroy a lot of jobs because they fail a lot, especially the smalls. Small enterprises rarely make it to 5 years. You know, very small percentage of them make it to 5 years. And so what you're having is a lot of churning and job creation and job destruction. So if you only focus on the creation part, you miss the destruction part and the churning. And even medium enterprises they last longer because they are more able to work in the ecosystem of the enabling environment of Africa with its limitations. But the point is they also don't grow to be large enterprises. Only about 10% of them grow. So what I want to argue is that actually Africa is missing the top, the large enterprises. Africa really has few enterprises with 1,000 employees, for example. And that's really important that those are missing. There are various reasons for that. We can talk about that. I want to say that this research that I'm discussing is not specific to the agribusiness sector. It's generic. And so you need to weigh that accordingly. And also, I'm a labor economist, not an agricultural economist, so I focus more on employment and jobs. Okay, next slide. Okay, so now it's really important to understand the firm cycle. Large firms start large, they stay large, and these are the ones that persist. If you look at these, panels of firms over time, and which ones have persisted and grown, you see that almost every developing country that has those panels, it's the large firms that have persisted. They provide better jobs, more secure jobs, higher paying jobs. The premium for working for a large firm can be 15 to 25% over education. The jobs are more likely to be formal. They're more likely to hire more skilled people. They're more productive, especially in manufacturing, including agro-processing, because there are returns to scale. They're more likely to adopt new technology, more likely to export, more likely to train their employees. And they can structure a sector. If you think about the automotive sector, for example, you have large firms that make cars, right? Firms that employ a lot of people. Then they structure their suppliers and the auto supply sector. Some of those are large firms, some of those are medium firms, right? And so if you didn't have the automotive sector structuring the auto parts sector, and some of the auto part makers were actually spin-offs from when the firms were more vertically integrated. But this is an example of how they structure the sector and create better jobs in the medium firms as well. And, they also can use a variety of financing modalities, including financing from venture capitalists, et cetera. But their real problem is they need effective logistics. So that is their big issue. Okay, next slide. Now, the problem is large firms are missing in Africa. They're more common in industry than in services in Africa. And generically, they're more common in industry than in services. So if you think about, for example, an input supplier, that's not going to be a retail input supplier. That's not going to be a large firm, right? So retail services, for example, can be a large firm from the point of view of, say, a supermarket. But in general, they often are smaller firms. But in industry is where you really see them and where they tend to be missing. And in Africa, what large firms you have, especially in industry, are often old firms with a lot of political power. And so the problem is they have used that political power to get too much regulatory protection. So they conspire with elites to keep out new entrants. They get all kinds of rules passed that make it difficult for new entrants, especially often FDI, to get the permits to enter the sector because they don't want competition, right? Now, and so African large firms are not as productive because they aren't threatened by competition, so they don't have to innovate. And that's especially true if they're producing for the domestic market. When they produce for the international market, they have to innovate because they have to keep up with the standards. So what's the implication here that maybe is worth thinking about for the agribusiness sector? It's not surprising to me that impact investors don't really want to invest in parts of the business sector because they don't want to invest in small firms that are going to fail, and they even find it hard to figure out which of these medium enterprises are going to make it and which ones are going to grow. It's hard to identify that 10% that might grow. So what I would say is governments and donors and the strategy needs to be to encourage large firms to attract capital and encourage competition. And at the same time, there needs to be a lot more work on the enabling environment in the financial sector. The domestic financial sector in Africa should be providing a lot more credit to medium-sized firms and even the larger small firms, but they're not. Domestic credit to the private sector is very low in Africa compared with other developing regions, even when you control for income levels. So we need to make sure that we have an ecosystem of firms and an ecosystem of finance, and that the two are matched, because that's how you're going to get a more structured and sustainable value chain and transformation and growth. Thank you very much.
Well, I hope you enjoyed that presentation by Louise. Some big challenges for us around what sort of ecosystem of firms and finance actually do create the best environment for SMEs and in turn smallholders to thrive. And also just to flag that the point that Louise made about regional trade in enhancing productivity, that will be a topic of the next webinar. So we'll mention that at the end of this webinar. And finally, before we go to the next presentation, I just wanted to remind you, please do post questions in the Zoom chat. Do start posting them now, even before we open up for Q&A, and then we can start to read them through and get ready to ask them to the panelists at the Q&A session. Now I want to call on Brian Milder from Aceli Africa. He's the founder and CEO of Aceli Africa, previously Chief Innovation Officer for Root Capital. He led the impact and advisory teams and designed impact-linked finance mechanisms to expand lending for new borrowers and support tree crop planting. He's also a co-founder and serves as Director of the Council on Smallholder Agricultural Finance, CSAF, an alliance of 16 impact lenders that promote industry standards and best practices for agricultural SME lending globally. Brian, over to you.
Thank you, Alice. Just want to make sure I'm unmuted. So I'm going to make 3 points today. And the first one contrasts with Louise's perspective. And it is that small and growing businesses in the agriculture sector have the potential to be engines for economic growth, and they're worth investing in. The second is that they are risky and costly to serve, and they're not all created equal in terms of their growth and impact potential. And the third is that, similar to Matt's point, we need to drive more and better data. We need to collect more and better data to inform solutions. And so first, around agri-SMEs, and I like this image because I think it really captures the role that agri-SMEs can play in supply chains, sourcing from smallholders, selling into markets, anywhere from input suppliers to cooperatives involved in primary production, post-harvest handling and storage and processing. And yet, if you could click, it's estimated that across sub-Saharan Africa, there's a $65 billion gap for businesses that need between $25,000 and $1.5 million in financing. That's an annual gap, and an estimated 3 in 4 agri-SMEs don't have reliable access to finance. So that's certainly constraining their growth. When I was at Root Capital, we did a lot of analysis of our portfolio. Root makes loans to about 200 agricultural SMEs a year in Africa, Latin America, and Southeast Asia. And we found, different from Louise's presentation, we found that 50% of the businesses in the portfolio stayed in the portfolio for at least 5 years. And those businesses had an annual revenue growth on average of 24%. So they're growing a lot, they're sourcing from more farmers, they're creating jobs, and often they're streamlining the supply chain, providing higher prices, more direct market access, and other services to smallholders. We know that some of the ones that dropped out are struggling and others have graduated. So we are seeing that a lot of these agricultural businesses grow, and just a couple of examples, Kenya macadamia nut processor that had less than 100,000 in revenues, just a few employees, grew to over 2 million in revenues, employing over 350 people in a matter of 6-7 years. A Ugandan farmers cooperative in a part of the country that was very remote, limited market access, many layers of middlemen between the farmers and market, grew from $1 million in revenue to 6 million in revenue in about 7 or 8 years. And farmers were getting substantial price premiums. So we know that these businesses can and often do grow. We also know that many don't. And finding the ones that have the growth orientation and accompanying their growth is very important. And it's not easy. It takes technical assistance. In the case of the Ugandan cooperative, they received support from a European foundation that built management capacity. And it also isn't profitable. So many of the loans that Root Capital and some other social impact lenders and even some banks make particularly under $500,000, but even under $1 million are not profitable in those first couple of years. And so the question is, can we find ways to value the impact that's being generated there, especially if lenders and investors need to go through a period of subpar returns in order to support their growth. Next slide. So Aceli Africa is informed by data that we gathered over the last couple of years from 31 lenders on 9,000 plus transactions, a few $1 billion worth of loans to agricultural SMEs. And we found that risk in the agriculture sector is in fact higher than in other sectors, at least double in our data set focused in East Africa. And next slide, please. And that returns are also lower. And this speaks to the challenges. It's not just a matter of risk, and the solution can't just be loan guarantees, because even when smaller ticket sizes repay, they're not profitable for lenders to serve or investors to do that due diligence. And so next slide, please. We need to find ways to shift the balance of the economics and to unlock more capital into the sector. Next slide. And so finally, it's how do we recognize and measure the positive social and environmental externalities of financing inclusive agricultural SMEs in terms of their sourcing, their employment, greater production of food and value add in the supply chain. And so with Aceli Africa, we're attempting to do that. We're offering financial incentives to lenders focused in East Africa. And those incentives address both the risk and the return side of the equation. And they're tiered to reward capital additionality as well as impact. So we pay lenders a higher incentive for loans that to businesses that didn't previously have access to finance, to businesses that are sourcing from smallholders and creating jobs, to those that meet a standard around gender inclusion or are producing food for local markets or practicing climate smart and resilient agriculture. And we're working with about 20 lenders across the region now. There's substantial interest. I think the trends have shifted in recent years. More commercial banks want to be in agri. So there's less of a push of the banking sector, and we're creating more of a pull mechanism for lenders to try to attract them into the parts of the market that previously have been hard to serve. In terms of the costs and how to pay for it, our incentive is about 7 cents on the dollar of every dollar private capital mobilized. We think that parts of the market require a little bit more than that, and parts a little bit less. And to the third point around data and evidence, the question is how much impact is being generated in terms of incremental income for farmers and employees, in terms of increased tax base and export earnings for the government, reduced food imports because you have greater productivity. We know that increased income in the hands of the poorest in a country is going to be spent on food, housing, healthcare, and education, and that's going to reverberate through the economy. And so we'd like to be able to make the case that this is a sound investment in economic development for African countries, and that they should adopt enabling policies to promote growing agricultural businesses. Thank you.
Brian, thank you very much indeed. Really, really excellent case for why we should be supporting that that type of business. And interesting to see that more commercial banks are beginning to come to that, and we can explore in the conversation as to why in detail you think that is. But looking forward to also hearing from Daniel Hulls, who has other perspectives on the role that those SME businesses can play. So Daniel, calling on you, that you're the Chief Executive Officer of AgDevCo, where Daniel's played an important role since 2011. He's an investment, public policy and development professional with over 25 years of experience in both the private and public sectors. He was the founding director of CEPA, a UK-based finance and economics consultancy, and was managing director until 2009. Prior to that, he worked for NM Rothschild in project finance and asset sales and at the UK Treasury. So Daniel, your perspective on this question.
Thank you very much, Alice, and thank you for inviting me. Just for those people who are not aware, AgDevCo is an impact investor that invests exclusively in agribusiness and in sub-Saharan Africa. We have 200 million of capital from the UK government, of which 140 million is invested in around 50 businesses across 10 countries. So we're Pan-African. We also provide investees with technical assistance, and in the year ahead, we aim to launch a new technical assistance facility alongside raising 100 million of investment capital from DFIs. I'd like to do two things in my remarks, and I find myself agreeing with different things from Louise and Brian's presentations. So first is to provide some reflections on the case for investing in African agriculture in response to Louise. And second, to describe some of the drivers for AgDevCo's evolution over 10 years of investing on the continent. So I have a lot of sympathy with Louise's challenge to us. Paul Collier, who is one of the trustees of AgDevCo, AgDevCo's holding company, argues that African states do not need anyone to tell them how to do politics or ethics. Rather, what they need is for large African and international companies to invest to create businesses across the continent. Sustainable formal firms, I believe, offer the best possibility for productive growth, well-paying jobs, and improved local production and processing. And yes, I think Louise is right. Larger firms in general offer greater potential of impact and organization of sectors. But what should be our response in the absence of those larger firms? Maybe two thoughts. I mean, I agree that the improvements in the enabling environment are important, indeed essential. Who could not agree with that? But in the meantime, what do we do? I am convinced that there's value in investing to establish and build productive enterprises in the sector. In our experience, some of them will progress from small to medium, and others have the potential to become larger enterprises in an agricultural context. And even those that don't and are carrying on have significant impact. And there's also a demonstration effect from creating such successful businesses that supports the evolution of the enabling environment and bringing new businesses and new investment. There's also a particular value in investing in agribusiness, and this is well rehearsed by many people, but it relates to the fact that the sector dominates employment and also, I think, offers the best potential for industrialization for most of the African economies through the process of downstream processing. So in AgDevCo's view, there is a strong case for investing with different models and at different stages to support the development of African agribusinesses, small, medium, and large. So how best to do it? For those of you who are familiar with AgDevCo and our evolution, you'll know that in the first 5 years, we invested at a seed capital stage, in the earliest stage formal businesses. And those are often owner managed, with typically very limited corporate capability, and where AgDevCo was the first third-party capital. Average ticket sizes in a portfolio of 30 investments that we made was around $370,000, so it gives you a sense of the size. Now, our current strategy looks at a later stage set of investments, typically in the 2 million to 10 million investment size range. And within that portfolio, we're deliberately targeting a mix of established profitable businesses looking to grow. And those include those going into new geographies and stages in the value chain. So it still includes greenfield activities, just with established businesses. And earlier stage businesses still seeking to get to profitability. But those businesses, as distinct from the seed, are typically a little bit further along, able to accept larger levels of investment and have more corporate capability. So we're still early stage, but just not the earliest stage. Now, why did we do this? 2 reasons. First, and these picking up on Brian's points. First, as AgDevCo, we needed to shift from relying on ongoing grant support. We needed to become ourselves sustainable. The hard facts that Brian has identified, we've lived them. Investing at the seed capital stage in this sector and geography is high risk and low return. And that means that we couldn't cover our costs if we continued in that space. Out of interest, we think we did pretty well, reasonably well. I think I could probably do better now, but across our seed capital portfolio, we managed to get back 70 cents on the dollar whilst achieving significant impact. But even if we had done better, investing at small ticket sizes is uneconomic, since it costs more or less the same to invest at, or at least actively invest and manage a 1 million investment in a high risk early stage venture to investing 10 million in a later stage profitable business. The absence of those investor economies are critical in this driver. But the second reason for our change, our experience then and now, is that we think we can achieve basically better impact for our dollar by the shift. Slightly later stage and larger firms typically offer proportionately more direct and indirect impact. And that's, I suppose it agrees a little bit with Louise, that's because the single biggest factor for success of a business and its sustained impact in jobs and food production and processing is its management and its corporate capability. And this very rarely exists at the same level in the earliest stage businesses. And interestingly, we found the same result in our companion technical assistance facility, the smallholder development unit. The bigger the business that we have supported, the better the impact. So if I may come back to the question of how best to support the development of formal agribusiness, I do think that AgDevCo's current strategy is right, but it's certainly not the only approach. We need larger investments by development finance institutions like CDC and smaller seed stage investors more akin to Aceli and the businesses that they are trying to support. I often think this, I ask myself this question, would I do it again? And I think probably the answer is yes. Having learned some hard lessons, AgDevCo would do seed stage investing again in the future. I can talk about some of the lessons later on another occasion, but I think we would only do it once we reach sustainability. We have the critical mass of networks with the costs of those covered from our balance sheet, and only, here's Brian's point, only with capital that is significantly concessional or potentially 100% grant. Thanks, Alice.
Thank you very much, Daniel. So good to hear the experiences from you and from the others, very much sort of from what you've done on the ground over several years. And I wanted to start the kickoff for the questions for all of you. And again, please do type questions into the Zoom panel. But I'm really fascinated by the different perspectives that you bring to this. Obviously, big question around which enterprises will grow and become sustainable, which are investable because they have impact and therefore should be invested because they have a wider economic benefit, and we need to measure those more, and which are able to be supported by the larger businesses, and therefore they get supported through investment effectively by larger businesses in the ecosystem. And so I wanted to ask the panel, sort of based on the experiences you've outlined, what do you feel is the way that investment in SMEs will evolve? We heard a lot about the need for concessional capital at the very bottom end. What's the role also for technical assistance in ensuring that they have the technical support and the business support to grow into businesses that can then be funded? And so that's the first question is what do you see the evolution of this space being, and the role of technical assistance and concessional capital in driving that? Brian, can I come to you first?
Sure. Well, I think first of all, there's going to be more scrutiny. I think that the work that AgDevCo and Root Capital have done over the last 10 years or so, and others have been involved in that as well, has been more pioneering, leading the conversation before we had good metrics for measurement and benchmarks. And I think we're also starting to see in the technical assistance field, there's more emphasis on evaluation and cost, and I think there's going to be more accountability. So I think at a minimum, the sector needs to get smarter about how concessionary capital and subsidy is deployed. And I think that's a good thing, but it will hold the feet to the fire of practitioners. I do believe, as I've said, that it is worth supporting earlier stage SMEs. At the risk of bringing in a false example, I'll note that in the United States, there's a community development sector. And it is a typical lender in the community development sector covers 65 to 70% of its costs, and the public sector subsidizes it. And it does so on the basis of the economic impact that's created from those loans. And of course, there's a political dimension to that, and the good arguments on both sides about whether that's appropriate policy. But I think we need to recognize across the world, in the agriculture sector, in small business, the government typically is providing a basis for commercial finance to flow, and that we shouldn't expect that things to be entirely different when we talk about lower income countries. Although certainly, we should do everything we can to encourage technological innovation and disruptive business models that will be more sustainable.
Fantastic. Thank you very much, Brian. I wanted to turn to Matt with that same question. Your research looked at the missing amount of money for that part of the agribusiness ecosystem. Can you give us a little bit more flavour of what types of investment might fill that gap in your view? So a question from Matt there.
Yeah, thanks. Working with Africa Enterprise Challenge Fund, which is also a significant provider of concessional finance to agribusiness and renewable clean energy technology. And I think it's interesting. AECF was established with a mandate to very much target those very large enterprises. The sort of repayable grants and the loans that were given out there were up to $1.5 million in agribusiness. The average was around $700,000. And I think that sort of the notion there is that funding these very large enterprises will crowd in other smaller SMEs into the value chain. But that picture's sort of changing over time. Now ACF is still doing many of these agribusiness investment schemes, but they're moving away from these very large grants, and that's in part due to the equity. There's questions about whether you can actually put funding into these very large enterprises, many of whom are foreign-owned, and we should be putting money much more in towards indigenously owned enterprises run by women, for example. So ACF their model is moving now towards much smaller loans, and also complemented with technical assistance. So there's this notion around having to support more at the smaller end with highly concessional financing. We have to build these pipelines of enterprises that are going to be available for subsequent investment, and that's going to take more technical assistance and this sort of longer term engagement with companies over time.
Thank you, Matt. I think what I would ask Daniel for that. First of all, apologies. I think my internet went in the middle of that. But I want to raise a question to Daniel, which has come in on the chat, which is about Uganda's experience, where financing agriculture is high risk compared to the attractive rates of return earned by just passively investing in treasury bills. So particularly if one's looking at the risks of agriculture, including climate risk and other risks, how can investment in agriculture compete with that sort of much more steady, much less volatile type of return? Daniel, shall I turn to you with that one first?
Sure. It's a difficult question, I guess. I mean, the problem that you face is local currency lending rates are high. Now, for any agricultural business, that creates a big problem, because most gross margins are in the kind of 10, or profit margins are in the 10 to 20%. So if you're having to pay 10 to 20% on your business, it's basically swallowing up any return you make. So it creates a big problem there. And I think Louise is pointing to the absence of functioning credit markets at sensible pricing as a big problem. Now, the way in which most investors come about that is that we offer hard currency loans, which can be lower pricing. And AgDevCo offers those in a way that's flexible and partly equity-like. But it shifts the problem in a sense, because that doesn't work for annual working capital, because if the exchange rate moves, you end up with a big problem. It works in the long term if you are investing for 7 to 10 years, because businesses can ride up and down movements in exchange rate. But essentially, the questioner is right. This is a really difficult point. And as an investor, we have to get around it by essentially the only way we can offer this is by offering hard currency loans, and only doing it in circumstances where the businesses have products that are linked to hard currency, or where we can do it in the long term and we can allow the ups and downs to pass through. I'm not sure I answered that very well, Alice.
No, really useful. Thank you so much, Daniel. That's excellent. And I just another emphasis on the returns are so difficult to achieve in some of these areas. So the need for patient capital, for some sort of concessional capital, while we have economic impact and positive impact rather than purely financial returns. And I think that reinforces that point. Mira Shah has asked, and this is perhaps one to first ask Brian on, what's the impact of COVID-19 on the underserved middle in Africa's agricultural sector, and how investors view the risk and return and impact of that space? So Brian, do you want to take that one first?
Sure. I suspect Daniel has a lot of insights as well. I think it's highly variable. So interestingly, you alluded to CSAF, the Alliance of Social Impact Lenders, in which I'm involved. CSAF members over the course of 2020 saw risk in their portfolio remain relatively flat, which was a surprise to all of us. We thought there would be a spike. Many of the businesses being served are in export value chains. They're more structured, and they were able to manage through with some restructuring of the loans. But we know that there are lots of challenges on the ground, that food insecurity at the farmer level, and many businesses disrupted, and in many cases trade disrupted. So I think it's highly variable. We also know banks are conservative, and banks took a logical approach early in COVID in terms of reducing their lending, and that I think is starting to return selectively. But there are also political dynamics at play, elections, et cetera. So we have in the agri-SME sector, and the part that I'm involved in, been pleasantly surprised that the disruptions haven't been greater at a portfolio level, although we know that the effects on the ground don't necessarily reflect that.
Thanks, Brian. Thanks. And Daniel, did you have a perspective on that one too, about how you've seen COVID affecting your investments and the way investors view the sector?
Yeah, look, it's broadly the same as Brian. We expected the worst, and we haven't seen it in our portfolio. We've seen some impairment, and partly that relates to the fact that we are producing food and we need food. Only those businesses that were relying on air freight really saw a hit, and most of our businesses are not there. Avocados, of course, is perishable, but those businesses were able to get over the logistics problems that they found at various borders. I have to say I'm sat here worrying, because we are undoubtedly seeing across the region, spreading up from the south, increased case numbers and increased impact. I had hoped that by virtue of demographic and climate, the worst of it would not hit Africa, but I am worried right now, is the honest truth. One thing to say though about how you approach this, and particularly for the smaller investments, it's kind of another reason why local presence here is essential. AgDevCo struggled last year, but we did still commit $40 million of new capital, and largely that's because we have people on the ground in various different countries. Most people in Europe were grounded and didn't go. So that is an important lesson for all investors who are investing across the continent.
Thank you very much, Daniel. A question from Simon in FCDO. So Louise and Brian both highlighted the importance of the domestic finance sector for missing middle SMEs. In addition to Aceli type incentives, what other actions can increase bank lending in particular? African banks are highly profitable. Is this potentially part of the problem? Brian, you mentioned that you're working with 20 commercial banks, 20 lenders. Do you want to start off with that question? I mean, what can increase bank lending to this sector?
Yeah, well, first of all, I am encouraged by some of the trends. One of the tier 1 banks we're working with in East Africa has about 1% of assets in agriculture, and they aim to grow that to 20% allocation over the next 5 years. And that's a strategy that they have independent of Aceli Africa. So I think we're seeing in more banks the creation of agri-units, driving down expertise to the branch level, opening up more branches in rural areas. And so I think we are going to see more interest from banks than we have in the past. The case of Uganda is very interesting. So in Rwanda, about 2 to 3% of bank lending goes into agriculture. In Uganda, it's 12 to 13%, and it's grown a lot in recent years. And the agricultural credit facility there, ABI, which offers guarantees, have been very important. Agricultural credit facility is a partial guarantee mechanism, and it also blends down the interest rates for the end borrower. So it covers half of the cost financing. I haven't looked at the evaluations of those policies, but they seem to be linked to the growth in bank lending in the sector. And I think more policies along those lines will create the motivation for commercial capital, particularly bank capital, to flow into the ag sector.
That's fantastic. And actually that also covers a question that was raised by Laura Norris, which was, given local credit markets being weak, does the panel have good examples of interventions with local financial sector actors to encourage financing to agriculture? I think that's been answered by that point you just made, Brian. Thank you. A question from Pete: what's the trade-off between investing directly with an SME versus supporting a guarantee with a commercial bank, who can in turn create multiple financial products which benefit multiple actors, input, suppliers, dealers, etc.? I think I'm going to broaden that out to a question, if you would forgive me, Pete, to a question about how can the sort of the larger parts of the ecosystem support SMEs, whether that's through these guarantee type mechanisms or larger investors in the larger companies supporting SMEs through that ecosystem. So I hope that's so it's a sort of slightly larger question from yours, Pete, but one about the guarantees with a commercial bank, but one about what can bigger parts of the economy do. Daniel, we don't have very long, I'm afraid, so just throwing you that curveball to answer that one quickly, if that's all right.
Very quickly, big DFIs do provide guarantees to commercial banks. It's at the scale that it needs to be, that level that it's provided, that supports them. But fundamentally, agricultural lending is atomized, it's too small. They can't do it. So the way in which you've got to do it is, as Root Capital and AgDevCo has done alongside them, is when you provide working capital through an agricultural entity like GADC cotton in northern Uganda. That acts as the principal. It has the corporate capability to organize, and critically, it wants the cotton and the sesame, so that it internalizes the risk of that credit relationship. Thank you.
Thank you so much. Apologies, we couldn't get to all of those questions. We are running out of time. Just a point to make about a piece of work that was done by ISF advisors and Aceli on the role of government in agricultural finance, with case studies on Uganda, Mexico, and Turkey. So we'll make sure that you can get a link to that if you're interested in pursuing that a bit further. So thank you to all of our panelists, Matt, to Daniel, to Brian, and to Louise, who hopefully will catch up with this after the event. It's been always too short, but there's lots of things we could explore further, but appreciate very much all of your really insightful comments. Our next webinar is going to be at 12 GMT on the 24th of February. So as usual, the last Wednesday of the month at 12 GMT. It's about delivering on regional trade, considerations for investors on inclusive supply chains. So some of the themes that we've been talking about here, we'll be able to pick up further with that discussion. To what extent can regional trade also improve the way that the ecosystem works, and access for smaller businesses or medium or the large being able to access regional trade. The other thing to mention before we go is that there is going to be a survey sent round to you to get your views on this webinar, so that we can keep improving and keep making sure that we're hitting the spot in terms of what you want to hear about. So please do, when you get that evaluation, please do respond to that. And please do join us in these webinars in the future. But thank you so much to all of our panelists, to Matt Hague, and please do go and access his report online on CASA, or there's a link on the chat, to Brian Milder from Aceli Africa, and to Daniel Hulls from AgDevCo, and also to Louise Fox from the Brookings Institution. And thank you very much, everybody, for joining us.